Good day and welcome to Get Mortgage Ready Online. My name is Rhonda Stark and I'm a mortgage agent with Invis. And today I am launching the first of a series of 8 audio tutorials designed to help you better understand and prepare for the mortgage process. These tutorials are based on the material covered in my new book, Get Mortgage Ready. Maybe you are thinking about buying a home and need a mortgage. Or maybe you already own a home and want to review or improve your mortgage situation. Maybe you are a student and just want to know more about mortgages and what you need to do to get one. Or maybe you are a business professional that deals with clients who might ask questions about mortgages or who would benefit from some pre-mortgage planning. Whichever category you fall into, you will definitely find this tutorial series informative. If at any point you think of a question or you would like to know more detail than is covered here, visit my website at www.moneyandmortgagematters.com to purchase a copy of my book or for information on how to contact me directly. I'd love to hear from you. Okay, let's get started. I have created a set of 5 steps to help you get mortgage ready. They are: first, assess your financial situation. Recognize how you got here, the positive and the negative. Second, seek sound financial advice from a mortgage professional to take you from where you are to where you want to be. Third, collect your financial information and provide it to your mortgage agent and lender. Offer complete financial disclosure and learn to get and stay organized. Fourth, set your financial goals, your mortgage goals, and your homeownership goals for the future. Write them down. And fifth, begin keeping track of your monthly expenses. Build a realistic monthly financial plan and commit to it. Our focus today will be planning, or to be more specific, planning ahead, so that you may begin this 5-step process. I cannot stress enough the importance of being properly prepared to begin the mortgage process. The better prepared you are when you start, the more smoothly the process will go, and you are more likely to achieve the desired result, which is obviously a mortgage approval. Once I have explained the planning ahead process in detail, we will then move on to step 1 of Get Mortgage Ready. Assess your financial situation, recognize how you got here, the positive and the negative. So how do you plan ahead? And how far ahead do you need to start planning? Well, planning ahead means starting to think about your finances before you need a mortgage, so you know what you can afford and you can feel confident you'll be approved. It does not mean that you begin thinking about your finance as you walk out the door to look at a new home or as you're filling out the mortgage application. The time to begin thinking about your financial position and planning how you will fit a mortgage into your budget can vary from person to person, depending on their situation. But my general rule is that you should begin the pre-planning process between 3 and 12 months before you envision needing a mortgage. Why 3 and 12 months? Well, let me explain. Planning 3 to 12 months ahead allows you the opportunity to first assess where you are financially now. Second, figure out how much you can afford to spend on a mortgage given your income and other expenses you have. And 3, it provides you with a reasonable window of time to identify and correct any financial or credit issues that may stand in your way of a mortgage approval. Here are 5 questions to ask yourself when deciding how far in advance you should begin to plan for your mortgage. A. Have you been working at your current job full-time for a year or more? B. Do you currently have cash on deposit that has been in an account for 90 days or more that you can use for a down payment on a home? C. Have you made any late payments on utilities, credit cards, or loans in the last 6 months? D. Do you know or suspect you have financial or credit issues on your credit bureau relating to either a marital breakup or other? E. Do you currently own a home that you will have to sell before moving into another home? Okay, if you answer yes to A and B and no to C, D, and E, you can probably begin planning for a mortgage about 3, maybe 4 months prior to your desired move-in date. With little to apparently stand in your way of an approval, the process should run smoothly. But the sooner you speak to a mortgage professional, the better. In the event that there are issues you weren't aware of or had forgotten about, the more time you have to resolve these issues before you submit your mortgage application to a lender, the better. If you've answered no to either A or B, or yes to either C, D, or E, then depending on how many answers were negatively positioned, you may need 6 to 12 months to resolve these issues before you will qualify for an approval. Contact a mortgage professional as soon as possible to begin the resolution process. Once you have considered your plan ahead strategy, then you can begin the more intensive process to get yourself mortgage ready. Which brings us to the first step of Get Mortgage Ready, assessing your financial situation. What this step involves is taking a look at your current finances and deciding whether or not you are happy with where you are. Are you struggling to make ends meet? Does there always seem to be more month left over at the end of the money? Or can you comfortably enjoy your lifestyle, having more money left over at the end of the month? Whichever situation you are in, it is important to recognize how you got where you are so that you can either stay on the right track for the long term or facilitate a change that will improve your financial position on a go-forward basis. In order to effectively assess your financial situation, you will need to make note of both your expenses and your income. The goal of this exercise is twofold. First, if you are having difficulty with your cash flow, this will help you to identify where the issues are and allow us to figure out how to improve things. Second, if your cash flow isn't necessarily a problem, but you want to make sure your savings practices are commensurate with your income level, getting honest with your spending habits is what you need to do. Okay, so at this point, take some notes on what I'm asking you to do so that after you finish this tutorial, you can work through the exercises at your own pace. First, you will need to write down the amount of income that you have coming in on a monthly basis from all legitimate sources. Income may include full-time or part-time employment income, Canada Child Tax Benefit, and any support payments you receive. Add all of your income sources together and highlight or circle the total for future referral. Next, write down all of the regular expenses that you have each month. Use 2 columns to list them. On the left, write down the actual expense name, such as hydro, that kind of thing. On the right, record the amount that you spend for each. If necessary, estimate the amounts if they vary from month to month. Once you have compiled an inclusive list, add all of the expenses together and highlight or circle this total as well. Before you do anything with your 2 totals, I'd like you to review your expenses list. Make a mental note of the expenses that you have that are necessary and compare them with those that could be considered recreational. Place an asterisk beside the recreational expenses and now ask yourself if any of these recreational expenses are wasteful or things that you don't need to do. The reason you need to examine your expenses, paying particular attention to recreational spending, is because it is often recreational spending that contributes to financial strain. Maybe not right away, but chances are one day it will. It tends to be the little things that we spend money on here and there, things that we don't really need, that wind up adding to a total amount that we realistically can't afford to spend, or that may prevent us from saving or getting ahead. At times when we are short on cash to pay the important things, financial strain begins. So whether we are overspending or undersaving, the result is the same, financial strain. The first step to correcting issues relating to financial strain is recognizing the details about where we are spending our money and which of our spending habits we need to change before things get out of control. Now, as I touched on before, another reason we should pay attention to recreational spending is so that we can see in dollars and cents the amount of money we could be saving each month instead of spending foolishly. By taking a closer look at the extras that we are spending our money on each month, we can calculate whether or not this amount is excessive. If it is, then you have room to redirect those funds to a savings plan instead. Now, I'm not saying that you should never go out for dinner, you should never treat yourself to a new outfit, or that you have to give up Starbucks. I know I could never give up Starbucks. All I'm saying is that if you're familiar enough with your financial position, you learn that you need to pick and choose between those extras instead of having them all, and when you commit to living within your means, life suddenly becomes a lot less stressful. The final task I will give you today is to go through your expenses list and number the expenses you have in order from most important or necessary, with a 1, to least important or not necessary, down to a 10 or higher. You get the idea. Once you have numbered your list, compare the amounts you are spending on each expense with its level of importance. The hope here is that your important and necessary expenses will be the expenses that you are spending the most on, because it makes sense for the majority of your money to be going to support the necessities of life. Note, as you plan ahead and assess your financial situation in order to get mortgage ready, ultimately you will want to make sure you have room in your budget for a mortgage payment. Keep this in mind as you calculate all of your numbers, especially if you're currently not responsible for a rental or mortgage payment. Funds for a mortgage payment will have to be incorporated into your budget, and the income must be there to support it. If you're spending a large chunk of your money on things that aren't important and you find you are struggling to pay your bills, then you can see there is a simple and logical fix for this. Minimize your recreational spending and apply more of that money towards your bills. Then, financial strain is reduced. If you are spending a large chunk of your money on non-necessities and you can still afford your bills, but you just can't get ahead and you don't have a savings, well, the same logic applies. Minimize your spending in the areas that are not important and apply that money towards a savings plan instead. You are now setting the stage for financial security. I can't stress enough here that being able to identify any recreational spending that is not necessary and doing something about that, like redirecting it into a savings account instead, really does set the stage for financial security down the road. Now, you may be feeling like these exercises are not important and that you can pay your bills just fine the way things are. Or you may think that you already know where all your money goes each month and that there isn't a problem with your spending because you try to be very careful. Or perhaps you just can't imagine that there's any room in your monthly budget to improve your financial position because you're struggling enough as it is. No matter what your thinking is, I urge you to complete these exercises anyway, if for no other reason than to see what your monthly financial snapshot looks like. If you can improve things even a little, whether it's by increasing your savings or starting a savings or just recognizing where all of your money is going, it is worth it, especially if you end up finding a little extra money in your budget. Next time, we will take what we have learned by doing our own financial assessments and discuss how to go from where you are now to where you want to be. Thanks so much for joining me today.